Yes, this is the Mark Haney Show, and today we have the privilege of having two guys from Clifton Allen, CLA. They're an accounting firm. I think they are one of the largest in the entire world. We'll get a little more heads up on that, but we're going to be talking about tax. We're going to be talking about finance, and today I'm going to be wearing three hats, and I have now here on the table. I'm going to be wearing my startup hat. You can see if you're watching on YouTube, I kind of have it on backwards because I'm a young startup guy. I'm going to be wearing my medium-sized businessman hat, like the Entrepreneurs Organization, and my investor hat, right? And I'll be talking a little bit more about that as we go throughout the show, but we're going to be talking about tax incentives, and really the strategies behind that. And I have Matt Winans. He is a principal at Clifton Allen, and of course John Kapral. He is a principal as well at CLA. How you doing, gentlemen?
Doing well. How you doing?
Doing great today. Good morning.
Good morning. Okay, so maybe we should just start by getting each of your backgrounds. Why don't we start with you, Matt? A little bit of your background and how you got to CLA.
Yeah, thank you. I started practicing in the Bay Area in San Jose, and specifically in the tech world, and served a large client base out of there, and 15 years practicing in the San Jose Greater Bay Area, and decided quality of life, let's move up here with the kids. My daughters are about ready to start kindergarten, so it made sense for the move, and came out here and continue to build the tech practice.
All right, so you got to focus on tech, and a number of our listeners are early stage companies building tech companies. So I look forward to diving into that with you, Matt. How about a little bit of your background? Or excuse me, John. How about a little bit of your background?
Good, sure. So it's a bit more, somewhat unconventional. Spent about a third of my career in public accounting, CPA. Also spent about a third of my career in practicing law. Technology law in the Boston area, and worked in .com 1.0, so I've got all the scars to prove it, and the lessons, hopefully. There's some wisdom that came from that. And about a third of my career consulting and working within companies to help them to get their funding and go next level. So it's a nice, well-rounded, interesting, fun career I've had, actually. And I'm in public accounting now. It's sunsetting. And the idea is I'm very focused on incentives and credits, Mark. It's something that I think I have a lot of passion for it, because I'm always looking at the way that a company can get a little more with what they've got. And we have so many great programs nationally, state, and local that really can help to fund a company, build their runway a bit, and that's where I spend most of my time these days.
Okay, well, let's start off in that realm then, because I'm thinking startup world, tech company. The plan is to scale, and typically these companies they're not as focused initially on the income side of things. They're not making a lot of profit at the beginning, so that's not the biggest focus. Matt, what should a startup be thinking about as they begin to build their business? Obviously, there's the formation, and then the other things associated with being a startup. What kind of things do you get into typically with startups?
Thanks, Mark. I appreciate that. Yeah, I always bring it back to my parents, and they always said, if you want to see what you're going to grow up to be, look at your circle of friends and your circle of influence, right? Same thing with a startup. I think the sooner you can get good, strong service providers in there to help you and actually add value, the easier it'll be for you to grow, and you'll be able to maintain that runway and that cash burn a lot better.
Okay, and let me dive into that a little bit. So when you talk about service providers, you're talking about like your accountant, right? Typically, you're not hiring on day one, you're not talking about hiring your full-time CFO, so you have basically something outsourced, and legal is usually outsourced. That's a service provider, marketing potentially.
Those are all service providers, and we can kind of circle back to John and I's history working together, which was starting with a lot of these small bootstrapped startup clients, these tech companies. And to be frank, income tax return for a loss position tech company, I'm not adding much value with that income tax return. Where I'm adding value is having those deep conversations about what do you have going on, where are you going, what's keeping you up at night, what are your pain points, and then rolling in John and his team and saying, hey, have you looked into these R&D payroll tax credit offsets? this is real value we can add outside of some pieces of paper that told you what you did a year ago.
Okay, so let's talk about those tax credits. If you're not paying tax, why is the tax credit important? And maybe give us an example of what somebody might be wanting to do in terms of applying for these tax credits.
Sure, Mark. So up until about 5 or 6 years ago, that was exactly the problem or the issue for an early stage company on going and pursuing R&D tax credits. It just made no sense. It would be burning cash for no good reason to just get a carry forward, something you could use at a later date. So Congress finally came around to the idea that, hey, we really need to be looking at the most innovative companies and helping them, supporting them, and they passed payroll tax offset provisions of the Internal Revenue Code relating to the research and development tax credit. Open the doors to some significant opportunities, and I'll give you the typical best case. It would be a company that might be out of a university, 3 or 4 principals. They've gotten their first money in, maybe $500,000 to prove their concept, and they're paying themselves because they have to. So they're paying payroll tax. They're paying FICA.
Right.
That's 6.2%. The company is paying because they're typically going to be a C Corp even at that point because they're savvy. They're getting the good advice out of the university support system. And so they're forming and they're paying themselves and paying that FICA. The company's paying the FICA. So that 6.2% can come back to them in a refund each quarter because those have to be paid. You could be pre-revenue, you could be pre-tax, and you're still obligated to pay those taxes, Mark. And so that's where the monetization started to make a lot of sense for early stage companies to pursue R&D tax credits.
So as long as you've got employees, you can find a way to claw back those R&D tax credits.
That's right. You can monetize them right out the gate, and that only was since 2016. And it's really been a boon for startups, emerging businesses, tech companies, and their payrolls because they're using that money to essentially, if they've got a $500,000 payroll, Mark, for instance, not a huge number today. As you know, you've got PhDs, scientists, researchers.
Yeah.
You can run up a $500,000 payroll very quickly. You're going to maybe be looking at an R&D credit of $20,000, $25,000, $30,000. That's monetizable. Mm-hmm. You still, if your state has a credit, you'll still get a carry forward, but you can't use it now, but it does have some additional value. So that's another $25K. So think about it. You've got $500K in, you've got another $25K. That gives you another, a 5% bump on your investment.
Yeah, a startup. So the biggest expenses we have is most companies, most smaller businesses, their biggest expense is the employee anyway. So if you can get that back, that's enormous. Now, the R&D tax credit, only a portion of our wages go to research and development, right? So how do you decipher from which is the research and development and which is, let's say, sales and marketing and other kinds of stuff?
So I think that's where John and his team come in and they have conversations and interviews with the developers and the software, the software guys, and they establish what percentages and what amounts are being utilized for specific research and development expenses that need to be onshore specifically for that credit. And that's one of the other things to be aware of, I think, is there's been a boom lately of offshoring R&D expenditures overseas, and that doesn't qualify for the R&D piece.
Okay, it's got to be domestic R&D. And then you have to, I suppose, you help the company sort of document that so you can. It's provable to the IRS, right? Is it the IRS that you got to prove it to?
Yep.
Yeah. And so what goes into that is because realistically, it's still a small company. They can't spend too much money on hiring you guys and documenting.
Yeah, I'd say traditionally speaking, our fees roughly 20% of the net credit, somewhere there, give or take. But John and his team come in, and for a lot of my client base that John's worked with, usually the first year is exploratory, and it's a little more painful the first year to kind of ramp up and scale with all the documentation that's required. But typically after that, it becomes much easier, more turnkey, because they know what we're looking for year over year. And John's team comes in and asks questions about, what are you using to track the software coding and where are you having these issues? And
All right. Well, I'm going to put on my medium-sized company hat for a second here. My EO hat. These are companies. The Entrepreneurs Organization usually has companies that are doing $1 million plus in revenue, maybe up to 100 million, a couple hundred million. But many of them are tech companies. Many of them are not tech companies, but they're very innovative. Is there a place in there for the non-tech company but they're a very innovative company to sort of start looking at R&D type tax credits?
Sure, and here's where again this became a focus, Mark. Back around 2000, early 2000s, 2003 maybe, the focus became commercialization, innovation, and that's bigger than software, bigger than life sciences. Now you're talking about giving U.S. companies an incentive to innovate that will give them a stronger position in the world. Create more opportunities in the U.S. for U.S. citizens, employees, and create new science, new IP. And so commercialization can go to any kind of product you can imagine.
Okay.
Looking at these boom mics, for instance, there's a lot of science and engineering that went into designing these, from the sound crystals and chips all the way down to the mechanics of the arm itself. A lot of R&D, a lot of know-how, a lot of ingenuity. And that would be qualified activity for an R&D credit.
Well, it seems easy to imagine somebody who's making a microphone, but what about somebody who is in the business of installing the microphone and they've developed a more innovative way to make the microphone usable, or maybe somebody who has a more innovative way to take it to market, right? There's innovation and technology associated with making the world run a little bit more smoothly, but it doesn't show up in the form of the microphone.
Right. Now, that's a good demarcation point. If it is something that goes to a management theory or technique or something to just improve a process through management, time studies, for instance, that's not going to qualify. It really needs to go to the hard sciences, something out of engineering, high-level mathematics, life science.
What about something that was where you're configuring something? So I have the microphone as a standalone product. Obviously, it projects sound. But then you've got the microphone, and when you put the camera together with it, and you put together the sound masking and the other things, it becomes a system that was engineered and took a lot of technology to master, if you will. Could the R&D associated with putting together a kit, could that be put in there?
You bet. That now you're talking about next level innovation. You're not just taking an instrument, a piece of hardware, and you're creating something bigger and more by using acoustical science, material science. Different things have different properties. You've got to look at all of that. Taking that into account, you've got mechanical engineering. People are going to be using CAD to design these things. You've got prototypes. Sure, there's plenty of opportunity there, and you could transfer that same idea to just about anything that you manufacture today.
Okay, we'll step back from it a little bit, and maybe we can talk about an example. I used a particular one because we're talking about microphones here on a podcast. But you think about construction companies, you think about other service companies. Are they a long shot to get an R&D tax credit, or really, if you make the right study and they're a growing company who is innovative, there's a good chance that maybe there's even an example of some of that?
Yeah, that's a great point, Mark. I do think there's a lot of opportunity out there that may be even untouched because people immediately think, okay, I'm a contractor, or I'm a video game guy. I don't have this R&D fact pattern, right? And the reality is, it's worth a call. It's worth a discussion.
Okay.
A lot of my clients, I've said, hey, it sounds like you're doing something that might qualify. Why don't you talk to John and his team and see what works? And I have a video game developer that they develop games for, the Apple phones and everything like that. They qualify. We have contractors that qualify. It's a pretty broad definition.
Okay, so go ahead, John.
And to supplement that, you've got the builders we look at that have the most opportunity are the design build or design assist, as you can imagine, because now they're typically working off of a fixed fee contract. It's on them. It's on their dime to whether they can successfully create a building, a structure, a facility. And where these are sometimes very sophisticated structures, clean rooms, they need to be especially secure for different reasons. A lot of R&D goes into that, and it's done through CAD today for the most part, and BIM. You're familiar with BIM, where you've got the plumbers, the electricians, the builders themselves, the GCs, all coming together with their piece of the puzzle, the architects, and it comes together, and you've got some beautiful next level innovative structure. There's a lot of R&D in there, a lot of engineering, a lot of raw know-how. There is some pushback, of course, from IRS. They would say, well, a building is a building. You're constructing a building. You know how to do that. That's perhaps true if it's a shell, but some of our structures today, we've got environmental issues. We've got issues of seismic concerns. I mean, so many things, Mark, that go into the complexity of building something today that give us enough to be able to create a case.
Okay, we dove pretty deep into R&D for this show, which is good because it's really interesting, and I think it's an area where most people we don't even think about this. So it's for somebody that is listening that might be a little more. Listen, step back from it a little bit. What are things that a startup might be thinking at the beginning of their journey that might not be as nuanced, I suppose?
That's a great question. I think there's a lot of opportunities there. One is, like you alluded to, the qualified small business stock, the exit, where you're going. I have a lot of prospects and clients that call me and they want to talk about entity structure and formation. And one of the first questions I ask is, what's your exit plan? Where are you headed? What's that look like? And then let's talk about that. And then we can kind of back into what qualified small business stock, and maybe a C Corp makes sense. Maybe it doesn't,
You bet. Yeah. So maybe we start there, because this is one of those questions that you sort of get every day. This is like an everyday question around here is, do I go LLC? Do I go S Corp? Do I go C Corp? And maybe you can kind of give us the quick breakdown on what route to take and what kind of scenario.
Yeah, it's going to vary based on facts and circumstances by every person and individual and company. I can tell you, for my technology-based clients, it ranges. I have S Corps, I have LLCs, and I have C Corps. It's across the map. I think for a company that plans to exit, maybe the C Corp makes sense for the qualified small business stock treatment and the deferral, or not the deferral, the omission of the gain for federal purposes. However, with the $3.5 trillion stimulus package that keeps getting brought up day in, day out, I think it's in the House Ways and Means Committee right now. They're talking about putting the clamps down on that and removing potentially 50% of that tax benefit.
The QSBS?
Yeah, for QSBS.
Yeah, so that'll be interesting, because we'll get to this. Like, I want to dive down a little bit deeper into what this is. So the startup is trying to decide what entity structure. Am I going to go LLC, C Corp, and so on? And the C Corp is what you would recommend. I guess I'm putting this in the form of a question, but is what I would recommend if somebody was going to go get venture backing. They wanted to get some angel investment money, then they're going to go get venture capital, and someday go public, right? They have that skyrocketing sort of game plan for their business. They're going to want to go C Corp. You typically say get a Delaware C Corp or Nevada.
That's usually what we see as a Delaware C Corp.
Okay.
For that specific fact pattern.
And somebody and if we go to an S Corp or a LLC or some other partnership, that's a pass-through entity. So you're actually running that income or loss through your personal tax return. And those aren't usually the companies that are going to get venture backing and so on.
Not necessarily. I think if you had an S Corp, for example, maybe you're bootstrapping your tech company and you're funding the bulk of it, and you want those losses to come through personally for the tax benefit. And maybe down the road you decide to talk to a VC and they say, hey, we want to come in and give you some funding. Well, then maybe you terminate or revoke your S election, become a C Corp, and move forward there.
Right. So yeah, and kind of breaking down, those are kind of some basics for starting up. And I want to dive a little bit deeper into the QSBS. Okay, what's it called?
It's a qualified small business stock.
Okay, I'm going to call it QSBS. It's fairly complicated, but I think it's something. And there's two hats that we can wear here as we're talking about this. One is the startup hat, because you're starting up a company and you're going to go C corp and get venture capital. And those are companies that should be thinking about this potential provision within the code that could be good for when you exit your company or when your investors exit your company. So I'm also going to put on my investor hat a little bit, because we know I do a little bit of investing. And I brought on my Sacramento Kings hard hat. The reason I brought this out, Scott and I were talking about the three different hats I'd be wearing today. If you go to a Kings game, I went when they were building the Golden One Arena, and they handed us this. We have a loft at the Golden One Arena, and the people that have the lofts and the suites and stuff at the Golden One Arena, they're investors, right? These guys are the kind of people, like, if you're out to raise money and you want to sort of follow where the investors are, you just go up to the loft area or the suite area, and chances are you're going to run into some investors in that section. So brought in my investor hat. With that hat on, we're investing into startups. Some are going to fail, and some are going to do real well. When they do real well, they end up having an exit at some point, and then you pay a big capital gain typically. Talk to us about where the QSBS comes in. And I know I'm not using that term right. So.
That's a great point. And so typically when you exit a company, there's two structures, right? You have an asset sale or a stock sale. And that's something to be cognizant of specifically with QSBS treatment, because it needs to be a stock sale to trigger that omission of the gain for federal income tax purposes. And there's a few requirements associated with qualified small business stock. It needs to be original issuance C Corp stock, less than $50 million in assets when it's issued. It needs to be held for 5 years or greater, and a few other requirements. But provided you check the boxes, when you exit, up to 10 times your basis or $10 million a gain is non-taxable for federal purposes based on current tax law.
Okay, so let me walk through this a little bit. I'm going to slow it down a little bit for somebody who might be listening, who's maybe an early stage investor, maybe a new angel investor, or maybe even investing into venture capital. So you invest into a startup. Let's say it's worth, it's a convertible note, right? Mm-hmm. So, or a safe, right? Yep. So it's not actual equity at that time. That qualifies, right? Because it's going to convert.
When it converts, so the 5-year clock begins on the date of conversion from debt to equity.
Okay, so it converts 2 years in, and by that time it's worth $20 million. Mm-hmm. So that's the value. It's below the 50, right? So you're good there.
So the 50 is the total, if you think about it, it's the total capitalization of the company, so to speak. It's the total assets on the balance sheet. Okay,
so the valuation of the company is not really the factor.
No.
It has to do with the assets on the balance sheet. Okay, yeah. Interesting. And so typically, when do you get up to 50? I mean, what would the valuation be? Maybe you can kind of give me some ballparks, like, okay, 50 million in valuation, that sounds like a pretty good size, or 50 million in assets, sounds like a pretty good size entity.
It is, yeah.
Yeah. Like how big would that company be? They typically have, they've raised a lot of money. They've had some sales.
In the tech space, that's a pretty big company, because most of the time when we see tech companies, the equity is the large number driving it, right?
Okay. And then typically, how long on a successful company is it going to convert over within a couple of years? I mean, in terms of like converting to equity, you end up with this hope that you invest in, and you hope that it is successful, and at some point another investor comes in and it converts to actual equity when maybe at the Series A level or something like that. That might be a couple years in, and then at that point, that's when the clock starts.
Typically, yes.
Okay.
And that's where we see most of those conversions happen, is when there's a round of fundraising.
So then you hang on from there, you hang on to it for another 5 years, and then when you have the exit, then at that time, what happens to your capital gains?
Provided you meet the requirements and you sell the stock of the C corporation to, say, a publicly traded company through an acquisition, then the gain is reported on your Schedule D as 8949 income, and then it actually specifically backs it out on your personal return for qualified small business stock treatment at the federal level. Now, it also depends on which state you're living in. So, for example, here in California, California does not comply to QSBS rules, so you're still going to get taxed on that at the California level at California rates.
Right, but you would do you defer on the federal level? Do you defer the tax, or it's basically free?
It's free money.
Tax free.
So when
and it's up to $10 million. Your first $10 million in profit.
First $10 million for the gross proceeds on the sale of the stock, or 10 times your basis. So if you've invested more than $1 million in the company of your equity, then it's 10 times your investment.
10 times. Okay, got it. Okay, so it's if you've invested $1 million, the maximum is $10 million. And then what if you've invested, say, $3 million into the company?
Then it'd be 10x. So
it's $30 million.
I believe so, yeah.
Okay, so that would be your capital gain. And maybe we'll back up a little bit, too, just to go a little bit high level or bigger picture. The difference between capital gains and ordinary income for people that are sort of coming in going, okay, capital gains is already a reduced amount of tax. Ordinary income, you're paying more tax, a higher tax rate on. Could you break that down for us just real quick for maybe the listener that's not as familiar with tax?
Yeah, so I guess looking retrospectively right now at 2020, the highest individual ordinary tax rates, roughly 37% Fed, whereas preferential long-term capital gain treatment is 20% Fed plus the 3.8% net investment income tax. So it's roughly 24%, call it. So you're looking at a 13% delta in savings.
Yeah, so it's significant
gain.
to hang on to the product or the company for a long term.
A year and a day, yeah.
A year and a day. A year and a day makes a capital gain?
Makes a capital gain.
Okay, so any asset that is it any business you would buy, but what kind of items would fall into a capital gain type of treatment?
Any sort of securities. So you have traditional securities through a brokerage account, publicly traded stock, as well as privately traded stock as well if you own, in a C Corp that's a tech startup company.
Okay. So you would be stock, it could be a house, right, as well?
Yeah, and houses get a little more complicated because if it's a personal residence, it's what's called the code section 121 exclusion, which is the gain omission on your personal residence,
right?
Which is, I think, is $250 per person and $500 for a married filing joint.
Right, but if it's let's say it's a rental property or some kind of investment property, they hold it for a year and a day and sell it, and you get capital gains treatment.
Yes, there are certain issues there as well with regards to depreciation. So if you've taken accelerated depreciation, there's what's called recapture that kind of claws back the ordinary deductions you took against the building.
Okay.
To equalize it, essentially.
Okay. So I'm gonna dive back into the QSBS. I've kind of bouncing around a little bit because I think it's important just to kind of frame the size of the opportunity a little bit. What other things are part of qualifying for the QSBS?
So I think the biggest hurdle we see is the 5-year and the structure of the sale. So depending on how you're selling it, I did a tally. I've had a little over a dozen clients exit at roughly $500 million of proceeds.
Okay.
So that's kind of just my background with this. And those exits have ranged from asset sales to stock sales, depending on the structure of the transaction. Sometimes when you look at these transactions, when you get into the room with the M&A team, which is mergers and acquisitions team, they're going to do some sort of gross up because a seller is incentivized to sell the stock to get that long-term capital gain or QSBS treatment, whereas the buyer is incentivized to buy the assets because when they buy the assets, they get to depreciate that asset immediately on their balance sheet. Whereas when they buy the stock, it goes into their equity section and they don't really get any tax benefit right away for it. So there's a bit of an adversarial relationship there between the buyer and the seller, and a lot of times there may be a gross up that gets done after the letter of intent comes through and there's due diligence.
Okay, so what? And I'm gonna come back to this asset versus the buying the company itself in a second. But what about when a company goes public? What happens there? Is that considered? And then you sell your publicly traded stock.
I'm not super familiar on on going public. We at CLA serve mostly privately held businesses. We do a little bit in the public sector, but not a whole lot.
You guys haven't had one of your tech companies do an IPO yet?
We do not typically do IPOs. So
Oh.
I
Yeah,
like
but the
to,
tech company does the IPO. You're helping a tech company, and it becomes an IPO, and you've got an investor like myself. Like I've got one that went public, and I haven't sold the stock yet. What am I gonna? I'm kind of curious. What am I gonna do on that?
Yeah. So typically what happens for us, since we're mostly on the private side, since we don't do a lot of SEC work, since once you go public, you have an SEC filing requirements and all that fun stuff.
Okay.
So typically by the time a tech company gets to that level, they have audited financial statements and tax returns.
Right.
And we'll typically make a warm handoff to one of the big four per se and say, okay, this is where our lane stops and their lane begins. They'll take you through the IPO piece.
Okay, so a guy I know just sold his company, and he was trying to decide whether am I going to sell the stock, right? Sell the company itself, or sell the assets within the company. Let's say he sold the assets, but a lot of it was goodwill. How does goodwill work?
It's long-term capital gain.
It's a long-term capital gain.
Yeah.
So if you can have it be classified as goodwill in the sale. So if you're planning to sell your company, if you're a listener out there, so I'm wearing my medium-sized company hat out there right now, and you've got this company, maybe you're a service provider, and you're going to sell the assets. If you can have that classified in the deal documents as a goodwill on the balance, they bought the goodwill on the balance sheet. Your goodwill is a long-term capital gain, so that's good for you if you're selling the company.
Yeah, and that kind of brings me back to war stories and experience, right? So I've had a bunch of clients go through those types of asset sales and exits, and one of the areas that really commonly happens is you have a buyer and a seller, and they have agreed upon terms and conditions to buy the assets of the company. Well, at that point, there also needs to be kind of how you split the baby of the company, right? How are you taking the $10 million they're paying you for your assets and splitting it amongst your accounts receivable, your inventory, your assets, the goodwill, right? Mm-hmm. And typically there's an agreed upon calculation or allocation of how they do that. And so then on the income tax side, when we actually file the tax returns, there's a specific form that marries between the buyer and the seller that breaks out that allocation. Okay. To basically comply and notify the IRS.
Okay, so I'm a medium-sized company, and John, we haven't had you weighing in here. We've been diving deep here with Matt. I want to make sure you're brought back into the conversation. And I know you're the R&D tax credit expert, but you're also an attorney, and you've good common sense way of handling it. So a medium-sized company's getting ready to have an exit, and they know it's coming within the next year or two because they've had some success. Maybe they're even going to run a process with an investment banker or something like that. And but they want to start getting their ducks in a row. I mean, what kinds of things do they need to be thinking pre-sale, and then maybe walk us through like afterwards, what are the kinds of things that they might want to do with their money so that they could maybe potentially shield themselves from having or defer certain gains?
Sure. Well, that really takes us to the idea of due diligence. And it's not just when there's a letter of intent on the table, but it's in preparation of that moment, because what you want to do as that company is get your house in order.
Okay.
You want to go through, almost do your own internal audit, and you're going to be going through your own books and records, making sure your accruals are good, making sure you're not leaving things on the table in the way of R&D credits, for instance. Get them done, get them in the bank before you go to sell the company.
You can't go back and go get R&D tax credits from years gone by.
Once you sell the company, it goes with the company typically. If it's going to be a stock sale, everything goes.
What if you're a company that really hasn't applied for the R&D tax credits yet? They haven't done that work, but they can you go back and like catch up from last 5 years?
Sure can. Again, sorry to go back down.
No,
this
that's kind of
rabbit
what
hole,
I'm intrigued because I know a couple companies that like this.
True. It's one of the most lucrative tax incentives and opportunities for an exit company, because what you do is you go back, and you can go back a number of years. If you've had NOL, you can go back to day one. You still have to
net
go
operating
through the rigor.
losses.
Net operating loss, yes, because you've never used the credit, even though it's technically beyond an open tax year. You could go back because you would have never used the credit. It's a rule that's allowable so that you can go back that far. Again, assuming you can substantiate the activities properly. You can go back I've gone back 10, 15 years in some cases. Some high-profile companies that were being acquired as their exit or were going toward positioning themselves for IPO that went back and cleaned up their books and records. And one of the things they did is went back and got another $1 million or $2 million on their balance sheet as R&D credits. And now in certain structures, and Matt can go to this a bit, to have that carry forward now on your tax return, and you're going to a transaction like this, you can wipe out gain with these credits.
You bet. So there's a real value.
Yeah.
The buyer is going to see real value in this loss carry forward.
Especially in the pass-throughs, because those folks get them on their own tax returns.
Right.
And so they got gain later from sale of the company. They've got those tax credits sitting there waiting to be offset, to offset that tax.
Okay, so I'm going to back up a little bit for the average person, though. I'm going to dive a little away from the tax credits, but just preparation. So you're getting ready to sell your company. You know what's going to happen in the next couple of years. You want to make sure your house is in order. You typically recommend that people get audited financials, reviewed financials?
It depends on the transaction itself, Mark, whether that's a requirement of the transaction. It may likely be in larger cases, the kind of companies you're thinking about, you're going to see that as a mandatory requirement in their letter of intent, in their documentation.
Well, when do you start getting? I mean, let's say you got a company. When would you start getting audited? Would that be like at $10 million in sales? Is there a revenue number that makes sense?
It depends on the purchaser. If it's a sophisticated buyer, private equity, a group that wants to roll up certain industries, for instance, they're typically going to require it. Matt, has that been your experience where you see that requirement for the audited, or are they finding compilations and reviews will satisfy them?
Typically, by the time it gets to an LOI, the buyer, in my experience, doesn't force an audit or reviewed financial statements. They've already done their due diligence. There's some special sauce they want that they can leverage. So they're kind of ready to go. Case in point, I just had a client recently exit. We were mid-review when we put the brakes on it for a reviewed financial statement because they had an LOI.
Okay.
So it was...
Yeah, once you get to that point. But what about just being proactive? You haven't even put your company up for sale yet. You know it's coming. Hey, it's time to start getting audited financials, so that way we have 2 or 3 years with audited financials. So then when we go in to run a process, look, I want it smooth sailing, right? Is there a... And obviously there's people that think that way.
That's a little bit of a different issue. And
Okay.
that, again, is being proactive. If you feel you might have some soft revenue recognition issues,
Okay.
you're going to want to evaluate that. You're going to want to determine whether there's any potential risk to the buyer or to you as putting your transaction together, that it could devalue the company substantially, or could, even worst case, the transaction would fail. So there are reasons for doing your own due diligence in advance of the formal due diligence, and that is to identify those areas where you've got some potential soft spots. And any startup has this. You know, people are churning and burning, Mark, and they're spending time on growing and building, and there are things that always need to be gone back and evaluated, reviewed, and brought into order, because going through a formal due diligence, it will get spotted. It will be identified either through the financials, the footnotes of the financials, even if it's not an audit, even a review with notes, or tax returns especially is where you're going to find a lot of things come out. And it really does affect valuations. That's one of the things you want to be proactive about. Have a nice clean transaction. Your lawyer's fees will go up. Your accounting fees will go up if it's an unprepared closing, if you will.
Mm-hmm. Okay, so let's talk about from a tax perspective, beyond the R&D tax credit. We're getting ready to sell our company. We've got audited financials. We've got we're good. Maybe we've even got a quality of earnings report done ahead of time. We're good to go. But I don't want to pay tax when I sell my company. That's my main thing. It's like, okay, I'm going to sell the company in advance. I know I'm going to sell it. What am I doing now to make sure that I minimize tax the capital gains that I'm going to pay on the thing.
That's where the phone comes in. You got to call your advisors and say, hey, this is what I got going on. Can we talk about it? Can we quantify what net cash in my pocket looks like?
Okay.
Can we discuss what that's going to look like, the different options I have? Many times for the bigger deals, we'll have a due diligence team on our side, the selling side, as well as the buying side, to quantify those things. We also, you alluded to CLA being one of the largest firms in the nation. We have an investment banking arm as well that can come in and look at it and say, okay, we think the LOI is a good number, or the multiple is a good number. Here's net cash in your pocket, that sort of stuff.
Okay, well, maybe talk about that. I mean, maybe we'll dive into maybe some little bit of hypothetical, just so we can put some meat on the bone. What things would you be, what kind of questions would you be asking, and what might be you fishing for, what information are you fishing for, so that you can make a recommendation?
So it'd be a few things. So kind of circling back to QSBS a little bit, there's also a 1045 rollover provision. So let's say you don't meet the 5-year requirement for complete omission of tax, the $10 million omission of tax on the gain of the sale of the stock. If you meet a 6-month holding period and you check all the other boxes, you can actually roll that gain into another company.
Oh.
So if you're a serial entrepreneur,
right, or an investor, right? Somebody who, let's say I angel invested into something, and we had, we only held it 3 years, but geez, I made some good money on it. No problem. I'm going out and investing into other startups. I could roll that gain into other startups.
Exactly.
What's my time frame for rolling that into?
Gosh, I'd have to look and see what the specific time period is.
Okay.
I want to say it's 6 months, but I could be wrong, so don't quote me on that.
Okay. And where does a fund? So some people are, I operate in the fund area where you're investing into several companies versus direct investments. QSBS work in that realm?
Yeah, it'll typically flow through a pass-through entity as well, a funded pass-through entity as well.
Okay. But it wouldn't fund somebody selling something on a secondary market. So if I bought a stock in some secondary market, it does not work that way. I got to work through the fund or directly with the founder himself or herself.
One of the first questions is it original issuance stock from the corporation?
Okay. Okay, so I'm selling my stock. I'm going to sell my company. What else are you fishing for? So you're looking for those kind of ideas. Is it a C Corp? Is there QSBS there? So we can potentially do a rollover, or we can get rid of all the gain. What about, I got my medium, maybe it's even a pass-through company. It doesn't qualify for QSBS. It's a pass-through entity, but there's still things that we want to be thinking about in terms of avoiding avoiding tax.
Oh yeah, absolutely. And that's where you come down to quantifying the specifics within the individual, and if it's ultimately going to be a pass-through entity and hit the individual's tax return, we start talking about philanthropic intent. Are there some organizations you want to donate to, and maybe that donation will help shield some of that income. Specific right now within California, I think it's Assembly Bill 150 that is the workaround for the SALT limitation, which is that state and local income tax limitation. So, for example, on your personal return, there's a $10,000 limitation for state income taxes paid, right, on your itemized deductions. And that was a result of, I think, the Tax Cuts and Jobs Act by President Trump. Well, a lot of these states came out and kind of developed a workaround, and California recently passed Assembly Bill 150 that said, okay, if you pay 9.3% in at the pass-through level, you get a federal deduction at the pass-through level as well, and then you get a credit on your California individual return. So you've essentially monetized that tax deduction. Now, I would say consistent with most of the laws that have been passed the last 2 years, the best way I like to frame it is we're still waiting on guidance and details. Tax law itself is roughly 3,000 pages, and the guidance and regulations is close to 70,000 pages. Okay. And we're still waiting a lot of that guidance and regulation because there's been so much in the way of tax law being passed recently.
Okay, well, we only have a couple minutes left, and we've gone. This is an interesting interview for me because I'm involved in these transactions. Other listeners may be going, man, this is a little bit detailed and complex. But I guess that's why you call CLA. I mean, you kind of said that a few times. If you end up running into one of these scenarios where it's like, wow, make sure you get the right guidance. So don't take any of this as guidance for your business today. Think of it as, hey, make a phone call, get an expert, and if you go through and do a little bit of planning, you're gonna be well positioned or better positioned to make good decisions. So right now we're going into year end. So this, being October, beginning of October, we're all starting to think about our tax law is going to change for next year. What kind of things should I be doing at year end in today's environment? Realizing we only have a couple minutes left on the show. What kind of things am I thinking about right now going into year end in this kind of year?
So one of the things, Mark, we're seeing a lot of is acceleration of capital gains into this year versus next year because of all the talk about raising the rates or cutting some of the benefits down. For instance, the QSBS possibly going to a 50% deduction limitation, things like that.
So take the gain this year potentially if you have that choice.
Right. One of the things too that pre-COVID, state of California was running projection about a $15 billion deficit. At this point, it's something like a $20 to $25 billion surplus, and it's directly related to capital gains being taken in the last year or so. Okay. So that is something that it's a good and a bad thing. The risk is that there is no movement in capital gains, and that there may be some devaluation on selling too early, things like that, getting out too early. But it seems like there's going to be something going up from here because they're really not going to get lower.
What about ordinary income right now? Would you advise that in terms of ordinary income too, to bring to realize as much income this year because we could expect higher tax rates next year? Is that something you're talking to people about?
Yeah, I think the general consensus is, like John mentioned, is rates are only going up. And so to the extent that you have cash available to accelerate income into 2021 and potentially pay tax on it, I think that makes a lot of sense. I think where it doesn't make sense is when maybe you're leveraging your cash in your business model and you can flat out outperform whatever the rate increase is via margins, right?
Right. Yeah, if you're growing like crazy and but you need to hang on to your cash, not pay the tax now, right?
Exactly.
Makes sense. Okay. Anyway, closing thoughts from each of you. I want to have each of you have a chance to any closing thoughts as you're talking to the any of the three hats, the investor, the medium-sized company, or the startup. Maybe share just some words of wisdom for people that are wearing one of those hats.
Yeah, I would say. Historically, CPAs kind of had the bad rap of being a historian who tells you what you should have done after you did it. And I pride myself in being more of a trusted advisor. I like phone calls. I like a heads up, and I think repositioning that perspective of saying, hey, my CPA is my partner in crime here. I want to talk to him. I want to tell him what I got going on. 5 or 10 minute phone call is not going to hurt anybody. And maybe we can avoid some icebergs on the long run.
Get out in front of it. All right, John, closing thoughts, last word.
Same, and I'll supplement what Matt was saying. One collateral issue that we didn't really touch on because so much rich conversation is the restricted stock problem, the 83B election, which is very much similar to QSBS. You've got to get those ducks in line in advance. What that is, you've got a key employee, you give them some stock in hopes that they'll stay around. That creates an opportunity for that employee. They can make an election within 30 days and they recognize gain on the value of that stock when they get it. And then later, when it increases and improve in value, it's taxed when it's sold, not when it vests. And there's a capital gain treatment down the road. So again, that is a tough one to miss. And I've had hard conversations because these are typically friends getting together and people get churning and burning and they're not thinking of these things. And it's too late if you miss that and you can't get into the
So your employee compensation issues, you should be talking to your CPA, your accountant, when you're getting ready to figure out how to compensate your employees with equity or options and so on.
Right. And it was a long way about of saying, talk to your advisors early and often, because they're here and there to help you so you're not feeling that pain down the road. And that really is something I've seen over many years of practice, that just communicate, talk to each other.
Nobody builds a truly great company alone. It's one of my mantras around here at Haney Biz and the Growth Factory. And today I think there's so much information when it comes to accounting and when it comes to minimizing our tax liabilities and just the strategy associated with making sure everybody in your company grows in wealth as the company succeeds. So so many times we think about just how to operate our company, but you've got to step back, think big picture. Matt, John, I want to thank you guys for coming on the show today.
Thanks for having us.
You bet.
Thank you.
Thanks for watching today's show. My goal for every episode is that you find a takeaway, something tangible you can use in your business today. And if you have a comment about a favorite takeaway, feel free to put it in the box below. And if you have a topic that you'd like me to bring up on the show, don't forget to let me know. And also, don't forget to subscribe to our YouTube channel if you want to learn more about entrepreneurship. Because at Haney Biz, we are always by your side.